as a limited partner passive investor. I've invested with a dozen different operators, a half a dozen different asset classes. And like you said at the beginning of the podcast episode, I've had deals that have been grand slams, and I've had deals that I've lost 100% of my money.
All right, ladies and gentlemen, this is Aaron Fragnito with the Passive Cash Flow Podcast. Here today with an excellent host, a man that's raised over $50 million, invested in his own deals as well, one of the leaders in the space, Jeremy Dyer. How are we doing today, Jeremy?
Yeah, I'm doing well. Thanks for having me on the show, Aaron. Really excited to chop it up with you.
Absolutely, my friend. I want to have you on here because not only are you a master GP in the space, but you also have a lot of experience in the LP space as a limited partner, investing passively, making money, losing money, and everything in between. And I think that's a really incredible story, and I wanted to hear more about that today. So before we get started, though, why don't you just give a little background on yourself for our listeners here?
Yeah, of course. Happy to do it. And thanks for that opportunity. So I spent the last 2.5 decades of my life in the tech sales space, and I was very blessed to be cranking out those commission checks and those bonus checks to the point in which I was fortunate enough by the time I was 24 years of age to be completely debt free, living in my dream home, had the 40-foot RV sitting in the driveway, had a couple of young kids, happily married. Life was going great, right? The challenge is that I was maxing out my 401k after the first quarter of every year and then wondering what to do with the rest of the cash, right? And of course, the financial advisor, was very in tune with, well, drop some cash into this index fund, that index fund. Obviously I wanted to try my hand at finding the next Tesla, Facebook, Amazon stock and riding it to the moon type of a thing, right? So at that same time, my wife and I decided, you know what, let's diversify into real estate. I had a passion for real estate, since I was younger. My wife had a knack for interior design work. My dad was a general contractor in the construction space. So we really had this team already put together. We had the GC license, we had the knack for interior design work, and I had the dry powder sitting on the sidelines ready to go. So we decided to start fixing and flipping houses back in 2012, and things were going really well at that time. We have some horror stories. We have some stories where we, did really well into that space. I do talk about a lot of those stories, in the active single family home ownership space in my book called The Fundamental Investor, for those that want to check that out. The challenge for us, however, Aaron, is we rolled into 2015 and my wife and I decided to double down on kids. Okay. So if you're reading between the lines, yeah. So we went from 2 to 4, reading between the lines. Numbers 3 and 4 were twins. Okay.
Right.
So it just got to this point in our kind of life journey where I had to step off of one of the horses that I was riding. Okay. At that time, I was working 50 to 60 hours a week, crushing the commission checks. I was also building up a growing and scaling single family home ownership portfolio. And I was trying to be a good husband, good father at the same time. My older boys wanted me to coach their hockey teams. That's every weekend and every evening up here in Minnesota. It's a year-round sport. So it just got to the point where honestly, I ran out of bandwidth. Okay. 2015 rolls around. We decide to get out of the active side. We go passive. Okay. Truth be told, I got into the passive side of limited partner investing in real estate syndications through the shotgun approach. Okay. I held my breath. I plugged my nose. Okay. I knew, I liked, and I trusted the main operator. But the truth is that I didn't even really know what the word syndication meant back then, other than I knew that the Green Bay Packers were a syndicated football team. That was the extent of my knowledge, right? So I got my teeth cut in the game back in 2015. That first deal did great. It was a home run deal, right? Since then, okay, since I got bit by the bug, I've now invested in over 40 different investments. As a limited partner passive investor, I've invested with a dozen different operators, a half a dozen different asset classes. And like you said at the beginning of the podcast episode, I've had deals that have been grand slams, and I've had deals that I've lost 100% of my money.
Wow. Wow. Oh my gosh. So you just kind of jumped in there head first. You found a good operator you like, didn't really understand necessarily the structure of the deal or making your money work for you there. But were those the deals that didn't necessarily work out, or were those pretty good? And it was later in your LP investment career that you ran into some challenges?
Yeah, the challenges that I ran into were really the deals that I invested my capital into in 2021. Okay. That was the peak of the last real estate market. That was a time where everybody was making money, everybody was speculating, right? Back in those days, an operator could buy a deal with a value add plan, never implement any part of the value add plan, and just watch cap rates compress. And they looked like heroes, even though they didn't actually force NOI growth through any type of a renovation plan. Okay. The deals that
Hmm.
I got into previous to that were virtually all home run deals. Okay, we're talking about deals that I invested my capital into back in 2016 and 17, where the industry was screaming a recession's coming, a recession's coming. Well, guess what never
Hmm.
happened? A recession. Okay.
All right.
So for those investors that sat on the sidelines between 2016 and 2021, you missed
Hmm.
out on a 5 year bull run. Okay. Specifically in the multifamily space. Well, now we fast
Hmm.
forward to 2021. Everybody's making money. Everybody's partying in the streets, right? That was
Right.
actually the time that people should have been more disciplined and sat on the sidelines. Okay. When
Hmm.
everybody was getting greedy, that's the time to get fearful. We take that out of Warren Buffett's playbook, right? So the
Yeah.
bottom got the rug got pulled out, okay, on operators that bought deals in 2021 when the
Mhm.
bases were significantly higher then than they are today, right? Second to
Right.
that, the operators that really struggled are the ones that purchased those deals with floating rate bridge loans, right? Maybe they didn't manufacture a going in interest rate cap on those deals. And we
Mhm.
get to 2023, 2024,
Yeah.
and those loans start to become due. And you've got deals now that if they were to refinance, they're refinancing at 92%, 94%. Well, you and I both know the banks aren't going to do those deals, right?
Right.
So
Mhm.
they're looking for additional liquidity. Deals are distressed. You know, the sponsors are trying to raise additional funds to keep the deals afloat. And a lot of operators are
Mhm.
forced to sell. Okay. And I invested in deals like that back in 2021 that have been subject to capital calls where the operator needs an additional 20 to 30% of additional liquidity pumped in from the existing limited partner investors to keep those deals afloat. I choose to
Mhm.
participate
Right.
in most, not all. Okay. The reason why not all is because some deals I don't trust that the operator is going to be able to right size the ship, the playbook, right? I don't feel
Yeah.
confident that
Mhm.
amidst the headwinds, amidst the remaining execution risk, amidst the operational risk that may exist with that sponsor, I'm not confident in their ability, okay, to get the wheels back on the tracks, okay? And for your
Right.
listeners, they fully understand this, the importance of aligning with a best-in-class operator like
Mhm.
Aaron and your team, for example, versus just chasing after the flashiest pitch deck when
Yeah.
really the operator behind the pitch deck might be two guys and a truck, right? With really no vision or playbook or experience or track
Mhm.
record
Mhm.
to
Yeah.
account for, if that makes sense.
Yeah, yeah, exactly. It comes down to like the financials. It does it's just like beautiful, high def, professionally done pictures. And you're like, this is just like basically real estate fluff. Like there's no real essence behind this opportunity. And those guys are raising like a ton of cash though. So I get, it's amazing what people look for. And then in my pitch decks, I have tried to have like all these in-depth numbers. Maybe I overcomplicate it, maybe I over detail it. But I feel like we want to disclose. And then my pictures are like me with my cell phone at the property on a rainy day. And that's not the way to, it's not always the best way to raise capital. You got to get professional photos on a sunny day. But that's why they make Photoshop. You can take the clouds out and you can put a nice sun in place. That's a good trick of the trade. But no, you're absolutely right, Jeremy. We've never done a cash call here, capital call. We've always tried. I thought back when rates were very historically low, you're like, yeah, rates are going to increase. That's definitely going to happen. So we assumed rates would be higher. And that, of course, causes prices to lower as well. But we also invest in a very strong market here and have an in-house property management company, so we keep tight control of our assets. But all right, so then you invest in some deals, kind of the height of the market there. You were doing really well. You were on fire with the returns, and that's tough. So you have some cash capital calls there that you did participate in, others that you didn't participate in. And what do you see owners and operators often doing in those scenarios? Are they selling sometimes at a total or almost majority loss to their LP investors, or do they just hold on to it and hope for better days? What are operators doing in those situations?
Yeah, obviously there's a lot of different, levers that the operator can pull. There's a lot of different potential outcomes in these types of scenarios, right? I mean, I've invested into, right, deals where there's been a total wipeout of all common equity in those deals, right? We're
Wow.
buying those deals at a
Wow.
30 to sometimes 40% discount from what
Mhm.
they would have sold, for just 4 years ago, right?
Yeah. Hmm.
Real estate is cyclical. Okay. We're in a down market right now, right?
Yeah.
I'm a buyer, right? I also understand the value and the importance of dollar cost averaging. Just ask your financial advisor,
Mhm.
about that strategy as it relates to Wall Street investing. So
Mhm.
there's a lot of different outcomes that can occur, right? But
Right.
there's also operators out there that are willing to do something in exchange for an investor
Mhm.
participating in a cash call, right? Or in the unlikely case that the investor loses a portion or all of the original invested capital, is the
Mhm.
operator willing to do something in exchange for that loss, right? And there's a number of different operators
Mhm.
out there that, in
Yeah.
fact, will do that to save face, right? Because they know that how important brand equity is. So there
Right.
are operators in the space that won't just issue a cash call. Okay.
Mhm.
It'll be a cash call, but new invested dollars into the deal get a high return or a high yield, a current pay. New
Mhm.
invested capital is promoted to the preferred layer of the capital stack. New
Mhm.
invested dollar comes with a corporate guarantee, right? And in some cases, some operators will say,
Mhm.
listen, we are very apologetic for what happened, which was largely, in our control, out of our control, right? As it relates to the Federal Reserve Bank aggressively increasing interest rates from really June of 21 through July of 22, right? It caught the industry off guard. Nobody really predicted that would occur. People
Yeah.
certainly predicted, higher interest rates, but did we know that they were going to go up 550 basis points over a 14-month period, right? So
Mhm.
some operators will also say, listen, we want to continue to grow. We want to continue to transact volume. Now's a good time to buy. It's not a good time to sell in terms of where we are at in the
Mhm.
economic cycle. So in exchange
Mhm.
for the fact that we maybe, had a cash call or we lost a portion of your original capital in a prior deal, in exchange for that, we're going to give you a better split on profits, on future deals that you choose
Mhm.
to partner with us on. And in full disclosure, I've been in
Right.
deals like that where I've lost 100% of my original invested capital with an operator, but yet since then I've invested in six more of their deals, right? Because I
Wow.
understand they're a good operator. Okay, they
Mhm.
didn't anticipate what would happen in the debt markets, right? Just like a lot of other operators didn't predict that, right? And they
Mhm.
just got caught off guard. That doesn't make them necessarily a bad operator. They speculated wrong, right? But so did a lot
Mhm.
of other people in the space today as well. So I think it's just
Sure.
really important for investors to understand that, again, to your point, you're not investing in the pitch deck. You're not
Mhm.
investing in the projected IRR because that's just a projection, right? That's not a guarantee. Okay.
Yeah.
There's going to be headwinds.
Right.
There's going to be future black swan events. And it's important for
Mhm.
investors to really make sure that they're doing the necessary and proper due diligence, on the operator themselves, because it's really the operator that you're investing into more so than it is, of course, the flashy pitch deck and the business plan itself.
At People's Capital Group, we help you invest in real estate. Build your wealth by owning professionally managed apartment buildings in the northern New Jersey market. We want to show you how owning real estate is attainable, even for the busy professionals that don't have the time or experience investing in real estate. Now, we only work with select people who are serious about building wealth, so find out if you qualify at peoplescapitalgroup.com. That's great. That's really interesting. So you had a situation with an operator where you knew he was a good operator, but didn't really project the future properly, which none of us can do. And then you invested in six more deals after that, which is incredible. And those deals, I assume he kind of gave you a better uh, position on, or maybe a better share class for but not investing the larger amount necessarily or something like that, right? Because I have the same thing. I have a share class for like family offices where you minimum $500,000 or $1 million investment with a higher preferred rate of return. And then I have the more retail investor share class with generally a $50,000 minimum that has lower preferred rate of return. But I guess he could let you into the better share class for still 50 or 100,000 or something like that. That's really incredible. So, and that's a testament to this operator's ability to manage your relationship, probably communicate, explain what happened, why it happened, what's the solution, and still maintain that relationship with you. Where a lot of people would assume, man, you lose someone's money in this business, you're out of business, your reputation is shot. But, savvy investors like yourself here can say, actually, this guy knows what he's doing, but it's just we had a bad egg here. We had a tough height of the market and so far that you've gotten into.
Yeah, no, you're exactly right. And it's important that we highlight these types of things because there's no such thing as a completely risk-free investment. None of this is, of course, guaranteed. But this same operator 2x'd my money on two other deals leading up to that, right?
Mhm.
In less than a 5-year hold period to the tune of
Mhm.
a 30%, IRR on those deals. The
Yeah.
same operator, by the way, has also had a few different cash out refinances on other deals that I'm in this year because it just made sense to pull some of the equity out,
Mhm.
de-risk the deal for investors, give them a portion of their original invested capital back, allow them to stay in the
Mhm.
deal at the same equity level ownership as when they
Mhm.
originally invested, right? So, I mean,
Yeah.
again, it's one of those things where the unfortunate, sad truth to this is there are investors that ran into the fire back in 2021 when everybody was making money. They got burned and they may never
Mhm.
come back again. But what they don't realize is that, again, dollar cost average, okay?
Right.
I'm a big fan of diversification. I'm in 40 deals as a limited partner investor, multiple different asset classes, different geographical locations, different operators, different business plans, different debt structures, right? I've invested at deals in deals at the bottom of the market cycle and the top of the market cycle. The truth
Mhm.
is that we don't oftentimes know where we're at in the cycle, okay? 2016 was supposed to be the top of the market cycle, but it wasn't, right?
Mhm.
2021, we were supposed to continue to see real estate values go up and to the right, but they didn't, right?
Right. Yeah.
So the question is
Mhm.
well,
Mhm.
where are we right now and what do we do right now in the economic cycle? And I can tell you right now, I am doubling down, okay?
Mhm.
I am in acquisition mode. Okay, I'm in attack mode right now
Mhm.
because I
Mhm.
know if you zoom the lens out far enough, okay, we will go up and to the right. And right now is a tremendous opportunity to get good cash flowing hard assets in the real estate space with or without a value add business plan at a significantly lower basis, price per door, than what people were able to get these types of assets for, just 4 years ago. And when
Mhm.
you have new supply falling off a cliff, okay, in certain markets in the
Right.
country,
Mhm.
that just creates
Exactly.
more demand, more absorption. And when you have interest rates that have largely stabilized, I don't think anybody's predicting that interest rates are going to increase. I think they may
Mhm.
be at this current level for longer, right? But we're also not underwriting lower interest rates,
Mhm.
going forward at this time right now. And I
Yeah.
don't think anybody should.
Right, right, exactly. Yeah, I underwrite assuming rates are going to be where they are when we go to refinance in 3 to 4 years, and I also underwrite assuming cap rates are where they are today in 3 or 4 years. And boy, if cap rates go down and rates go down, then we'll be in a really good spot on the deals we're buying right now. But I agree, real estate is on sale. Interest rates have remained not historically high, but higher than they have been in the last 5 to 10 years. And because of that, prices have decreased, cap rates have increased, and we're just seeing some really great deals out there. I mean, right now, I can buy brand new Class A real estate, fully leased up for 300,000 a door in Newark, New Jersey, and I get a deal like that every couple weeks or so, and like that. If you think about it, in a high demand area here, Newark, New Jersey, 30-minute commute into Manhattan, If we wanted to go build an apartment building there, it would cost about $300,000 a door to build it, and maybe even more, really, like 350 or so with the land and everything. So we're pretty much buying them at the cost that it costs the builders to make these things. So it's like, man, you're getting them for a great price, sometimes below replacement cost. I'm buying 78 units in Hackensack for $191,000 next to the number one hospital in New Jersey. And like if I want to rebuild that, it would be like 350 a door, so you're just getting out. It's an older class C building, but we're going to reposition it and make it into a nice class B, and still be into it for maybe 225 a door. So just really great opportunities out there. Rents continue to stay strong, so it's just like the perfect time to buy real, perfect storm. We're like, when I talk to investors and they say, well, I'm waiting on the sidelines, I'm waiting for interest rates to go lower and cap rates to compress, it's like the opposite of how the wise way to invest. That's like saying, well, I'm waiting for the stock market to go sky high to buy stocks. It's like, well, wait a minute, you're supposed to buy low, sell high, not buy high, sell low. But so many investors have that mindset, and it's really a shame, because the savvy investors, the family offices, the ultra high net worth individuals, those are the people writing the checks today, where a lot of the retail investors writing a $50,000 or $100,000 check are much more cautious. And what that tells me is now is a great time to invest, because chances are, if you have $250 million net worth and you're willing to plunk down 5 million right now, but if you're $1 billion net worth and you're, not willing to put down 50,000, well, I'm usually follow the investment strategy of the people with the $250 million net worth. So that's who I'm seeing is actively investing now. And we are out there talking to large fund of funds, equity groups, family offices, and larger scale investors that are eager to get in on these discounted buildings that used to be going for 4.5 caps. Now we're buying them at 6 caps. So it's a no brainer to me. And you're seeing thing in the markets that you primarily invest, like the Carolinas and Texas. Is that right?
Yeah, that's exactly right. I mean, we're, predominantly, in Dallas and North Carolina, markets like Charlotte, Greensboro, the Triangle Park area of, Raleigh, Durham, Chapel Hill. And I mean, in those markets, we're still seeing high absorption rates, right? We're still seeing organic rent growth in those markets.
Mm-hmm.
And we're still, believe it or not, there's some deals that I've invested into a year ago with 100 doors, and we've only renovated 1 or 2 units. Well, why haven't we renovated the rest of them? Well, predominantly because we're achieving, at or close to pro forma rent increases on those non-renovated units, right? So if
Right.
your listening audience knows a little bit about, yield on cost, right? It doesn't make sense for us to renovate a unit that demands $150 per month, rent bump, if in exchange for that, we're going to have to provide tenants with concessions if they're already willing to pay our pro forma rent increases in those markets. So there's a time for operators to put their foot on the gas, and there's times for operators to pump the brakes. But
Mm-hmm.
that's why it's important to be aligned with the best in class operator that has, an asset management team that looks at their, KPIs on a monthly basis to determine, where we're at right now in terms of where we can push, NOI growth, relative to the types of concessions that we may or may not have to provide, relative to, where we're at from an economic occupancy perspective versus a physical occupancy perspective. So just a whole lot of different factors that go into it. And not every operator, unfortunately, is in tune, with the types of strategies, or capable, I should say, of pivoting the strategy, multiple times over the course of the investment hold period.
All right, Jeremy. So one last question for you. What would you advise to your LP investor self from 2015? You're writing that first check to where you are now, over 40 LP investments later. What would your main piece of advice be to that person?
Yeah, I've got a bunch of them, right? But I'm going to just highlight two of them, maybe three if I think of a third one. The first one is, before you ever make an investment into anything, okay? I don't care if that's Wall Street or Main Street, okay? The first investment you need to make is in yourself, okay?
Yeah.
You need to go buy a book or two on the topic. Um, I authored a book called The Fundamental Investor. You're welcome to check that out on Amazon. It's a great book for people to learn about passive investing in real estate syndications as a limited partner investor. Okay. So educate yourself, consume podcast content, listen to Aaron's podcast. Great place to start, right? The Passive Cash Flow Podcast. All right. So great tool here. The next thing is once you've gotten educated, okay, you got to get over analysis paralysis or
Mhm.
paralysis by analysis. The best way to learn about passive real estate investing is by doing it, okay?
Mhm.
I tell LP investors all the time, okay? You're never going to know everything you need to know about this type of investment until you actually get started and you start to learn your way through that process. And the
Mhm.
truth is that, and this will resonate with you as well, Aaron, our real estate acquisitions,
Yeah.
okay, that we're acquiring today,
Mhm.
they are worth what somebody is willing to pay for them at the time that we sell. Do
Right.
we really know what somebody's willing to pay for a property we're acquiring today in 5 years from now? Okay. If you've got that
Yeah, of
crystal
course not.
ball, I'd love it. Okay. I
Right.
don't know, you don't know,
Mhm.
but we have a fiduciary responsibility to
Mhm.
protect and preserve investor capital. We also
Mhm.
have a tremendous amount of alignment of interest with our investors, right? And in cases
Yeah.
with you, you probably have a pref return. So you give
Mhm.
those cash flows, those first cash flows to your investors before you
Right.
start taking a profit. You know, all
Mhm.
those things are really important for people to understand that if
Mhm.
if if your investors aren't making money, you're not
Mhm.
either, right?
Sure.
And so it's
Mhm.
really important that we buy at a good basis, that we execute our business plan, that we have solid operations, that we've
Right.
reduced execution risk as much as possible. And
Yeah.
so those are just a couple of things that I think people should know.
I love it. I love it. It's great, Jeremy. So how can people get in touch with you and learn more about you there?
Yeah, I'm pretty active on LinkedIn, so you can go jump out to LinkedIn under Jeremy Dyer. It's Dyer.
Mhm.
You're also welcome to check out my book, The Fundamental Investor. And again, you can find that out on Amazon. I also host my own podcast called The Freedom Point. And Aaron was blessed to have been a guest on my podcast a few weeks ago. So you're welcome to check out that episode as well.
Thank you so much, Jeremy. Awesome, my friends. And to our listeners, if you're enjoying this content, Jeremy here is a wealth of information. So definitely check out his book and his content out there. And but share this episode with someone who you think might gain value. Maybe a friend or a colleague or a family member that's thinking about getting into real estate investing. They're kind of on the fence. They don't have any experience, but that's the whole idea as an LP investor. You don't have to know everything. You don't have to know exactly how the whole market works and the repositioning and what the operator's strategy is. Just understanding the basics of it, building rapport with the operator, having that trust there, and understanding that the general key KPIs of the investment, and then having a plan and sticking to that plan is important. As Jeremy said, paralysis by analysis is a common issue with investors. So know what you're investing in, know the risks and rewards. But at the end of the day, once you're done doing your due diligence, pull the trigger, invest in real estate. It's been great for Jeremy and I both as LP and GP investors. And I see so many investors miss out on deals. And then, years or months later, they regret it. And then they kind of over invest in the wrong deals or the wrong operators, or the shiny objects. So, pick a good operator, stick to them, maybe have a few that you like to invest with, diversify over a number of deals, and build your wealth in real estate. And of course, share this episode, like this episode if you're on YouTube. If you're enjoying our content, please subscribe to our podcast, the Passive Cash Flow Podcast. We come out with a new episode every 2 weeks here. And I'm the co-founder of People's Capital Group. I focus on helping people build and preserve their wealth through New Jersey real estate here with our own in-house property management company. We actually have a new offering coming out. We got up to 90% subscribed already from our Whisper campaign. So we're on fire over here. So check us out at peoplescapitalgroup.com. Thank you so much, Jeremy, for coming on the show, my friend.
Yeah, thanks for having me. I really appreciate it, Aaron.